Great. So under topic number 6, we'll be handling 5 sections. The first part, we are talking about applications of certainty inventory models. That is economic order quantity and economic batch quantity in decision making. So we're going to do some simple introduction under that. We have stochastic inventory models with and without stock out costs. We'll be looking at marginal analysis for perishable stock items, application of simulation models in inventory control with and without back orders, application of strategic management decision in inventory control. We'll be doing something about just-in-time, activity-based costing analysis, and material requirement planning. So that is it. Now, for us to introduce this particular topic, we have to go back to intermediate level, and we have to go back to intermediate level and get to understand what we discussed there, and then proceed to the advanced level. So at intermediate level, you did something about inventory management. You did something about inventory management. Inventory management. Under inventory management for stock, setting of stock levels, you can refer to it as setting or stock levels. We just did some introduction there. So number one, we talked about this particular, we talked about minimum consumption, maximum consumption, right? We talked about average or lead time, maximum lead time, minimum lead time, right? So all those things, they were helping you, number one, to give us maximum. So you were able to calculate maximum stock level. You looked at something about minimum stock level. You looked at something with regards to average stock level, and of course we talk about number of orders. Now we look at maximum stock level. This is the maximum amount of stock we should be having at any given time. So that's maximum amount of stock. Number one, it has got what you call safe quantity or safe stock, and then of course what will be sold to the market. Then the minimum stock level, that is the lowest that you can have at any given time. Average is now maximum plus minimum, then you divide by 2. Number of orders, we're going to look at total demand in a year, divide by economic or the quantity at equilibrium point, right? So you also talked about equilibrium quantity. But with all these, we are trying to look at minimum stock level, maximum stock level, so that we get to minimize, the cost of taking care of stock or inventory. So the cost related to this particular stock, number one, we are talking about purchase price. So we have purchase cost. We are talking about the amount of money you are going to incur to initiate the purchasing process. For you to be able to even do research to get what is available in the market with respect to your intentional demand, then you'll be incurring what we call ordering cost. What you're going to pay to prepare the ordering process until you get these goods delivered to your premise is what we call ordering cost. So we also have ordering cost, not just the amount you are paying to the supplier, no. Apart from what you are paying to the supplier, you must incur some cost to transport these goods to your premise. You have to incur some cost to go and look for these particular products. You have to incur some cost to pay your employees to be able to get these goods, the right quantity and of course the right quality. Then, having done that, you'll be having these goods in your warehouse until they are sold to the final consumer. You are getting these goods from the supplier, you bring them to your premise. Before you sold them to the final consumer, you must take care of them. You must put them in your warehouse. if you are dealing with perishable goods, you must control or regulate the temperature around the place where they're actually stored. So all those costs will be recorded as holding, stroke carrying, carrying costs. So these are the costs you are going to incur to be able to deal with your inventory. The three of them, right? So it means for you to be able to get the total cost of dealing with your inventory, we must incorporate these three cost components. So how do I get now total cost? So total cost of taking care of inventory, total cost of taking care of our inventory will be number one, purchases or purchase cost, purchasing cost, right? To that, we add ordering cost, and of course, with the ordering cost, we add holding. Cost. You partially covered this particular concept when you are dealing with economic order quantity at a discounted price. That is, the discounts given to you when you increase the quantity, right? So let's apply, we tell you know what, if you increase and purchase this number of units, you will not purchase them at 500 shillings. No, we are going to give you a discount and you'll pay us 470. So you interacted with this formula somewhere at intermediate level. You did not stop at this point. You went ahead and told us, you know what, our total cost here is equal to purchasing cost. So how do we get the purchasing cost? We took demand times purchase price, that is annual demand, plus we also went ahead and discussed something about total ordering cost. For us to be able to get total ordering cost, number one, you are supposed to identify number of orders. So how do we get number of orders? It is annual demand divided by quantity, annual demand divided by quantity, then you multiply it by ordering cost per order. To that, you added total holding cost. So this holding cost is dependent on the units that you are having. But ordering cost here does not depend on the number of units. Ordering cost depends on the number of orders you are going to make. And therefore, holding cost here will be quantity divided by 2, then we multiply by holding cost per unit. So this one here will give us the total cost of dealing with any given quantity of inventory. Great. Now, as a company, you are not going to stop at this point. At any given time, all companies will be striving to be able to do what? To be able to minimize on the total cost of taking care of this particular inventory. So you want the company to operate at equilibrium point. You want this particular company to operate at equilibrium point. So at equilibrium point, we expect total holding cost, that is demand. We can have it in words, first of all. Total holding cost. Total holding cost should be equivalent to total ordering cost. So we expect the company to operate at equilibrium point. And at equilibrium point, total holding cost is equivalent to total ordering cost. So I want us to use this function here, these two, the one representing ordering cost and the one representing holding cost, so that we get the final equation at equilibrium point. So let's do that. We'll come to this place and say, you know what? Total holding cost, we say here, total holding cost, that is quantity over 2 multiplied by holding cost is equivalent to total ordering cost. That is demand over quantity, right? Multiplied by ordering cost. So that is the equilibrium point. That is the equilibrium point. Our equilibrium point, we need to get the quantity. So what are we going to do? Can we make Q subject of the formula in this particular question? Good. So let's do that. How do we make Q the subject of the formula? We can divide both sides by or multiply both sides by Q. So Q quantity over 2 multiplied by holding cost is equal to demand over quantity multiplied by ordering cost. So for us to make Q the subject of the formula, we multiply both sides by Q. We multiply both sides by Q, right? So here we are going to have Q squared over, that is Q squared, holding cost over 2 is equal to demand times ordering cost. Now that Q has answered that, our intention is to make Q the subject of the formula. So let's go ahead. We'll be having now this. We now again multiply by the reciprocal of this. So we'll be multiplying by holding cost over, 2. We multiply that by 2 over holding cost, then 2 over holding cost. Again, this will cancel out. So we are having Q squared is equal to demand times ordering cost times 2, right? Times 2. Then we divide by holding cost. I believe someone is already seeing where we are heading to. So Q squared, we can do the arrangement, study the number. So 2 times demand times ordering cost will give us, or divide by holding cost. Our intention is to get Q, not Q squared, the quantity at equilibrium point. We need to get Q, not Q squared. So how do we get Q? We will do that by getting the square root of these numbers on both sides. So square root of a number squared will be that number. So our Q is equal to root of 2 times demand times ordering cost divided by holding costs. There's that common name which we are used to. Can you give me the name of this Q or this one here? There's another name we normally use for this particular formula. Can you please write it down there? Can you please write it down there? Economic order quantity. So the Q we are having here is economic order quantity. That's how we get the economic order quantity. So at this particular point, we have been able to minimize on total cost. That's number one. Number two, the company is operating at equilibrium point. We cannot reduce total cost beyond this particular point where we are operating with the economic order quantity. So as we progress to topic number 6, this economic order quantity will be a very important concept in topic number 6. So we have to just understand how it operates, right? Good. Now, having done that, we can now go ahead and get total cost of dealing with this particular units. So the first thing, you can now see whenever we have quantity, we are going to now replace it with the equilibrium quantity. That is economic order quantity. Economic order quantity. So that's what we have. That is the quantity that this particular company should be ordering at any given time. At any given time, they want to make an order, they need to order the economic order quantity. That will reduce, number one, the total cost of dealing with these particular goods. Number two, that will enable them to meet the demand within the lead time. So that takes us to another term. That takes us to another term, or these other terms that we need to take care of here. We need to take care of. So I know some of you who are dealing with the manufacturing companies here, and your employer or that particular company, they have a set standard. or even if it's not a manufacturing company, they are only purchasing consumables, right? They are only purchasing stock which are being used within the company. They have that particular limit whereby if product A gets to 10 units, they must initiate a new order. They must initiate a new order. So we have this term called reorder. Reorder point. Reorder point, your company says, you know what? If product A gets to 10 units, then we must make a new order. So this 10 units represents the reorder point. Your company says, the moment we get to 10 units of product A, then you're supposed to start thinking on how to get additional units. So this 10 units represents reorder point. Then from that, having identified that there are 10 units, we must make a new order. But that new order, you must be specific on the quantity we are going to order. So that is what we call reorder. That's what we call reorder. That's what we call reorder quantity. If my units gets to 10, I must make a new order. But any given time, I'm going to make an order, we must purchase 50 units. We must purchase 60 units. So therefore, 50 units in this case will be the reorder quantity. If our units get to 10, we must make a new order. And if you're going to make a new order, we must order 50. We must order 50 units. That again takes us down here. As we order 50 units, the ordering cost will not be dependent on the units we are going to order, but it will be dependent on the number of orders. Our total ordering cost will be dependent on the number of orders. That's why when you look at our total cost function here, we have demand divided by economic order quantity. We have demand divided by economic order quantity multiplied by ordering cost per order. So total ordering cost will be annual demands divided by economic order quantity multiplied by ordering cost per order. So the ordering cost does not depend on the units being ordered, but it depends on the number of orders we are going to make. Then from that particular point, so number one, we have been able to identify the reorder point. We now understand what reorder point is. Another name of reorder point, of course, it can be reorder point stroke reorder level. Good. Reorder quantity. So if I don't have reorder quantity, remember this reorder quantity should be that quantity which helps the company to minimize on the cost of dealing with inventory. So should you find a question whereby you are required to use the term or you are required to use reorder quantity, but this reorder quantity is missing, you don't have any additional information referring to reorder quantity, then please go ahead and locate the term economic order quantity. You can also remember when you are doing the intermediate level part of this particular concept, if you are given a question and you are supposed to use reorder quantity, and if you look at the question, there was no reorder quantity, you are supposed to identify economic order quantity. Same to this level, when you're told to use reorder quantity, and you cannot get it, please locate economic order quantity. But now at this particular level, the examiner will not give you economic order quantity under any additional information. No. The examiner will not give you economic order quantity under any additional information. Instead, the examiner will give you annual demand. The examiner will give you ordering cost. The examiner will give you holding cost. I believe it is the same group that did management accounting at intermediate level. And even the holding cost, you will not be given the holding cost. Instead, the examiner will tell you, you know what, holding cost is 20% of the purchase price, or holding cost is 15% of the purchase price. So with that information, you should be able to get economic order quantity. And once you have the economic order quantity, you now go ahead and use it in place of reorder quantity. You now go ahead and use it in place of reorder quantity. Good. Item number 3. Item number 3. You have decided to make an order today, right? You've decided to make an order today, Wednesday. But for you to be able to receive these goods, you must wait for 14 days. You must wait for 7 days. You must wait for 3 days. So the 14 days, the 7 days, the 3 days represents what we call lead time or reorder period. The interval between the time that the order was made and when the goods are received. That's what we call reorder period or lead time. Reorder period or lead time. It will be very important to us to understand that if I'm going to make an order, then I cannot say the following day this goods will be available. No, I have to wait for some time. So as I even tell my customer that, you know what, as at now, I don't have the product. I've been able to make a new order, but you know what, you have to wait for this number of days to get the goods ready. So that is done by considering the lead time. Okay, we are going to do that. Good. We are going to do every basic thing. That's why I started with this particular point. So you are taken care of, don't worry. Good. So we have to understand what lead time is, what lead time is all about. Good. Now, we are not going to stop at total cost being purchase price plus ordering cost plus holding cost. No. Something will be happening in between. We are supposed to have 10 units, right? We are supposed to have 10 units for us to make a new order. So our units have reached 10. We've made a new order of 50 units. And this lead time is 4 days. This lead time is 4 days. Now, lead time being 4 days, we have customers who have been able to come for this particular product and we wait for 4 days to receive the 50 units. But something happened. Something happens now on the 3rd day, before we receive this goods on the 4th day, right? On the 3rd day, something happens. A customer comes for the goods more than what we actually have in the store. Let's say we have, it gets to 10 before we make a new order, or for us to make a new order. So we made a new order, we are waiting for 50 units within 4 days or after 4 days. Now something happens that a customer comes on the 3rd day and our opening stock is only 5 units. Our opening stock is only 5 units. But now a customer comes and says, you know what, please give us 12 units. Give us 12 units. What will happen? You have your opening of 5 and the demand is 12. What will you have? You have a deficit of how many units? We have a deficit of 7 units, right? We have a deficit of 7 units. The moment your stock gets to the negative figure, we are talking about stock out. We are talking about stock out. So that stock out will be added to these 3 costs: the purchase price, the ordering cost, holding cost. We are going to add the 3rd one or the 4th one, that is stock out costs. This stock out cost, it is not real expense. In some books, they're going to call it opportunity cost. Opportunity cost. So if someone comes to your premise to purchase a given product and you don't have, you cannot tell what you don't have, right? You cannot sell what you don't have. So what will they do? They will go to your competitor. They will go to your competitor or your neighbor who is selling the same product and purchase it from them. So what will happen? It means that revenue which would have received by making sales of that particular product will not be realized. Why? Because you don't have those particular goods in your stock or warehouse. So what will happen? The money you are supposed to receive in form of revenue will be taken to your competitor or your neighbor. So you've lost that money. There's nothing you've incurred. There's nothing you've incurred. There's no cost you're going to incur. There's no service you've offered to be able to claim that money. But because you don't have the products required, you will not receive that revenue. So it is not literally money that is lost. And that's why in some books, they're using the term opportunity cost. They're using the term opportunity cost. So we are going to introduce this cost number 4. That is stock out cost. This stock out cost is dependent on the number of units that is required. So for example, if I were to calculate stock out cost for this particular scenario, my stock out cost will be stock out cost per unit multiplied by the deficit that is realized up here. We need 7 units. Demand is 12, we only have 5. So we have a deficit of 7. And therefore, total stock out cost will be stock out cost per unit multiplied by 7 units to give us this total stock out cost. So as we get to this level, it means our total cost will be purchase price plus ordering cost plus holding cost plus stock out cost, right? Plus stock out cost. Great. Now what you'll be able to see is that ordering cost is dependent on the number of orders. Holding cost is dependent on the number of units that is available as closing stock. Then of course, stock out cost is dependent on the number of units. And of course, we're talking about deficit. We are talking about deficit. Good. Someone's talking about lead time. Someone's talking about lead time. So this is what normally happens. If you make an order today, that is Wednesday, 2nd of October, right? You're able to make an order for how many units? For 770 units. So you have been told by your supplier that, you know what? For us to be able to deliver these goods to you, we need like 5 days. We need to wait for 5 days to receive these goods. So can someone help us? When are you supposed to receive the goods? When will you receive the goods? If you make an order today, you're supposed to wait for 5 days. When will you receive the goods? When will you receive the goods? When will you receive the goods? When will you receive these particular goods? You're supposed to wait for 5 days. You're making an order today, 2nd of October. When will you receive the goods? So you're talking about 3rd October, 4th October, 5th October, 6th October, 7th October, 8th October. Let me just list the dates there. Good. So let's see. Give me the dates. 7th day, 7th, 8th. Good. So we are going to again agree on something here. As we handle this particular concept, as we take care of this particular concept, this is what we are required to do. When you are told that you have to wait for 5 days, the 5 days includes the day that the order was made. So your 5 days will be from this Wednesday. That will be day 1. 3rd will be day 2, day 3, day 4, day 5. So when are you receiving the goods? You'll be receiving the goods on 7th of October. As you count the waiting time, include the day that the order was made. The 5 days includes Wednesday. So day 1 will be Wednesday, Thursday, Friday, Saturday, Sunday, and then Monday, 7. So we need to understand that as we deal this back with as we deal with this particular concept. Up to that particular point, are we together? Are we together? Are we together? Have we been able to learn something? Have we been able to learn something? Great. Now, just to give a simple explanation, we have economic batch quantity. So economic order quantity is the minimum or the maximum quantity that a company will be ordering for them to minimize on the cost of making that particular order or even taking care of those particular goods. When we come to economic batch quantity, we are now talking about manufacturing firms, right? Manufacturing firms or companies. Now here, they are not making an order, but they are doing production. They are doing production. You understand very well that you know what? The cost of producing, one textbook is higher than the cost of producing 10 textbooks. Is that true? The cost of producing one textbook is higher than the cost of producing 10 textbooks. So those who did intermediate level management accounting, in reference to topic number 7, that is marginal and absorption costing. Under that particular topic, we were discussing something to do with the cost of production. We had two methods, the marginal costing system and the absorption costing system. The difference between those two methods is basically how we are going to deal with the fixed production, overheads. The fixed production overheads. The manner in which we are going to deal with the fixed production overheads will determine whether we are applying marginal or absorption costing method. So under marginal, from the word margin, this will only entail variable cost components, not just any variable cost, variable production cost. And the variable production cost entails direct material, right? We also need this concept at some point. Direct labor. So these two, or any other direct production cost or expense. So these three will give us what we call prime. These three will give us what we call prime cost. So you need this knowledge again when you get to topic number 7, that is budgetary control. So once you have your prime cost, we have two items here, the production overheads. The production overheads are divided into two. We have fixed, we have variable production overhead. So when we only bring variable production overhead to form part of product cost, then we are using what we call marginal costing method, right? Good. Having done that, what about absorption costing method? So absorption costing, we are going to have all these items and add the third or the fourth one. So we have direct material, direct labor, direct production cost or expense. So these three will give us what we call prime cost. To the prime cost, we are going to add number 1, variable production overheads, fixed production overhead. So when you bring these two together now, we are getting production costs. That's the difference between these two. Under absorption costing, the fixed production overheads forms part of product cost. Under marginal costing method, it is only variable production overheads that will be forming part of product cost. Why am I bringing all this? We want to look at the fixed production overhead. The fixed production overheads will help us calculate something to do with overhead absorption rate. The overhead absorption rate will help us to get, again, something called overheads absorbed. Overheads absorbed. So, for example, let's say our fixed production overheads was budgeted at, let's talk about 1,000. Our fixed production overheads was budgeted at 10,000. That 10,000 is constant. Remember, is the same concept we are going to learn in this topic too. Yes, I'm trying to give you some explanations of what we are going to do so that we now get to the actual question. It will be very simple for you and you'll easily understand the concept. Good. So when you come to these fixed production overheads, remember the components of fixed production overheads. Number one, we can talk about depreciation of plant and machinery, right? Depreciation of plant and machinery. We are talking about insurance expense of plant and machinery. We are talking about rent and rates, right? We are talking about lighting, right? Talking about lighting. We are talking about salaries and wages of the production manager. Wages and salaries of the production manager. So these fixed costs, whether you do production or not, whether you get to work or not, you must pay for them. So if you are living in a rented house, whether you are working or not, you have to pay rent at the end of the month, right? Now you getting to work and getting more money will enable you to minimize on that particular expense. How will it help you to minimize on the expense? Remember, if I only produce 1 unit for the entire month, then the cost per unit that has been produced will be this 1,000, right? Look at it. So we have cost per unit. This cost per unit, I want to get the cost. So the fixed cost, I have 1 unit. For, let's talk about 1,000. Yeah, we have 1,000, right? And also still it will be 1,000 when I produce 1 unit, when I produce 10 units. The fixed cost will be constant, irrespective of the number of units I'm going to produce. But let's now look at cost per unit. Cost per unit will be that fixed cost divided by units produced. Units produced, right? So when I produce only 1 unit and fixed cost is 1,000, what will be the cost per unit? 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 1,000 divided by 1. 1,000 divided by 1. It will be 1,000, right? If fixed cost is 1,000, I've only produced 1 unit. It means the entire fixed cost will be taken care of by 1 unit. So that's 1,000. How about if you manage to produce 10 units? If you manage to produce 10 units, what will we have? So 10 units here. 1,000 divided by 10, we'll be having 100, right? What if you manage to produce 100 units and the cost is still constant? What will we have? 10 shillings. That is cost per unit. So as the volume increases, as the volume of output increases, cost per unit is actually reducing. Cost per unit is actually reducing. That's what we are going to see here under, or that's what we'll be able to apply under economic batch quantity. So it will be reducing up to a given point whereby it cannot reduce beyond that particular point. It will be the equilibrium. So we need to get the equilibrium units of output that will help us minimize on the production cost. That equilibrium units of output is what we call economic batch quantity. How many units should I produce per production so that I minimize on the production cost? That is what we call, those units will give us what we call economic batch quantity. It will give us economic batch quantity. Good. So I believe that explanation is enough. That explanation is enough for us to be able to handle an illustration. So without taking much of your time, I'd like us to look at which city. Our first question should come from, we can look at November 2018, question number 3C. November 2018, question number 3C. November 2018, question number 3C. We can look at November 2018, question number 3C. November 2018, question number 3C. November 2018. November 2018, question number 3C. Let's look at it. Let's look at it. November 2018. Okay, let's see. So as look for the question, let me see on what I can do. It should be May 2018. Question number 3C. Good, so the question reads, Mamboleo Limited buys and sells a single product branded Z. The demand and lead time of the product are uncertain. The following probability distribution has been provided. So we have demand, probability, lead time, probability. Additional information, the ordering cost per order, we have 80 shillings. The holding cost per unit per day is estimated at 2 shillings, while unit shortage cost is 20 shillings per unit per day. The reorder quantity is 40 units and the order level is 20 units with a beginning inventory balance of 30 units. Using a simulation of the above problem for 10 days, determine the average daily cost using the following random numbers. So number one, from the word go, in some questions, they are not going to separate the random numbers. Look at the random numbers given to you. They have actually specified 68, 13, 09, 20 to be for the demand. And then lead time, we are having 30, 22, 70. No, in some questions, actually the November 2018 sitting, question number 3B, they did not separate the random numbers. They were combined together. So it is upon you to identify, how am I going to pick these random numbers? The manner in which you are going to deal with the random numbers is determined by the number of digits given in the probability table. Depends on the number of decimal places given in the probability table. So that's what we are going to deal with in this particular question. The first thing you need to do is to give us the demand table, to give us the lead time table. Good, so let's get to have that table drawn here. The first thing we need to identify is dates, which we'll be able to consider, right? Days. Then we have opening stock, random numbers, demand, and then we get our closing stock. So the first thing I'm going to start with is the days. We are told to do it for how many days? For 10 days. We're supposed to do it for 10 days. So before when we do it for 10 days, somewhere there, we need to get this demand. We need to get this. So let's start with the demand. Let's start with the demand. Probability. Cumulative probability. Cumulative probability. Then we have range. Right, so demand we have 3, 4, 5. So we have 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Then we also have now lead time. So we have lead time. Lead time given there. Then we have probability. Cumulative probability. Then we have range. So lead time is given there as 2, 3, 2, 3, 4, 5. 2, 3, 4, 5. Great. So with that, we should be able to get the rate. So are we able to get the probability? Yes, that's given directly. So we have 0.02, 0.02, 0.02, 0.08, 0.11, 0.16, 0.19. Remember, your probability must add up to 1. It must add up to 1. So if it is above 1 or less than 1, just know something is not right. Good. Let me pick the probability down here so that once we are done with the probabilities, .15. Good. So I believe we all have the figures now. We all have the figures with us. We all have the figures with us. So let's start with the first one. Let's start with the demand. Now, cumulative probability, you pick the first one here, transfer it to this part. So how do you get cumulative? It is this one here plus the current figures amount of the current demand, quantity range, amount here. Do the same all the way, the last part. So once you get to this point, your cumulative probability should be the summation of everything here. Let's do that. Good. Another thing that you need to consider, the number of decimal places is very, very important. You know, someone is now wondering if this one here is 0.2. Why are we adding 0 here? Is it adding any value? As far as this concept is concerned, you must just include this 0. 0.3. There's nothing to be added there. Why are we adding it and making it 0.30? The addition of 0 here is very, very important because it will determine how you are going to come up with this particular range. The number of digits in your range is influenced by the number of decimal places under the probability column, and therefore we must just consider that 0. Great. So let's go ahead. 0.02 plus 0.08. What are we getting? 0.10. 0.10 plus 0.11. 0.21. 0.21 plus 0.16. What will you have? Is it 0.37? 0.37 plus 0.19. What are we getting here? Is it 0.56? 0.56. 0.56 plus 0.13. Is it 0.69? 0.69 plus 0.10. Is it 0.79? 0.79. Then 0.79 plus 0.08. Is it 0.87? Thank you. 0.87. 0.87 plus 0.07. Is it 0.94? 0.87. I have it here. Yes, 0.94. 0.94 plus 0.06. What are we getting? It should be 1.00. It should be 1.00. Good. Now, with that, we can actually get the range. Your range is determined by the number of decimal places given in the question. How many decimal places were we given? For demand, we have 2 decimal places. So we must maintain 2 digits under range. We must have 2 digits under range. So we have 0, 0, 2, 0, 1, 0, 2, 2, 0, 9, 0, for 1. It should be 10. It should be 10. It should be 10 to 20, 21 to 36, 37 to 55, 56 to 68, 69 to 78, 79 to 86, 87 to 93, 94 to 99. We're actually doing something which you did in advanced financial management simulation. I believe you can recall that. I believe you can recall that. Good. So that's how we deal with 2 decimal places. That's how we deal with it when given in 2 decimal places. Let's come to lead time. I want to show you if we are to use 1 decimal place. Now we have this giving us 2 decimal places. So if we have 1 decimal place, the digits will be, if this one was 1 decimal place, it would have been 0, 2, 1, 2, 2, 9, right? 10 to 20. If it was 1 decimal place, but if you have 2 decimal places, we must maintain that. We must maintain that pattern. So let's come to this part. I believe you can now do this. without any problem. So cumulative probability, we pick the first one, 0.20. When you add it here, 0.50, 0.85, 1.00. Let's come to range, 0, 0, 2, 19, 20, 14, 9, 15, 18, 4, 85, 2, 99. Good. So that's what we have. That's what this pardon on the range. You start from 0, 0 to a number before what you have. What do we have? 2, right? So the number that comes before 2, 1. Then now this one here will be the starting point for the second range. So we come and step 0, 2. 0, 2 to a number before this one here. This one will be 10. A number before it is 9. That's why we're having 9. So that when we get to the second next range, this one here becomes the starting digit 10. To which number? To a number before this 21, which is 20. So 21 starts the other range. To a number before this, 30 what? 36. But when I come to the next range, this one here becomes the starting point. So that's how we do it all the way to the last part. Is it okay now, Norbert? Is it okay now? The same applies to lead time. The same applies to lead time. Good. So I want us now to go ahead and come up with a table. I want us to go ahead and come up with a table. So this table number 1, we are going to have the days. Then once we have the days, we'll be having random numbers. Then we have our opening stock, we have our demand, we get the closing stock. So let's start with the days and then we go to random numbers. Let's start with the days here. Let's start with the days here. Then come to random numbers. Then go to opening stock. Then go to demand. Then go to closing stock. Let's have that in place. So they told us to do simulation in terms of days or weeks. Let's see. Using simulation of the above problem for 10 days. So this column here represents days. How many are they? 10. So we have day 1, day 2, day 3, day 5. Day 10. Good. Then here we talked about random numbers. Then we have opening stock. We have demand. We have closing stock. Then once we have our closing stock, the next column, holding cost. Do we need an order? So we are going to talk about holding cost. Do we need an order? We need an order. If yes, then we're going to do what we call ordering. Ordering cost. I'm going to make an order. So with the ordering cost, we need to come up with what again? Random numbers, lead time, shortage cost. We are going to have random numbers here. These random numbers will help us to get what's called lead time. The lead time, we can get shortage cost. Shortage cost. Shortage cost. And now we have to total cost. get total costs. Then we get total, yes, opening stock. Opening stock is here. We get demand during that particular day. It will help us get closing stock. We need to have, if we have closing stock, of course, holding cost will be incurred at some point. After holding cost, so you're now asking a question, do we need an order? If yes, then automatically we'll be having ordering cost. If you don't need an order, no ordering cost. No ordering. So please have the table down before we get started. Have the table down there before we get started. Have the table. Have the table before we get started. And then you confirm. Have the table before we get started, then you confirm. Correct. So I believe we now have the table with us. It should not take us a lot of time to have the table down. Do we all have the table with us? Do we all have the table with us? Great. Now, we will pick the first random number. Which random number are we going to pick here? After shortage cost, what is that column? The last column is called total cost. Total cost. So our total cost will be holding cost plus ordering cost plus shortage cost plus shortage cost. Great. Now, let's see. The first random number that we're going to pick is for which item? Is for the demand. It is for the demand. So in some question you'll find they are not going to separate 68, 13, 09. No. You'll be having 68, 13 or 68, 30. It will be a continuous number. For example, 68, 13, 09, 20, 73, 07, 92, 99, 93, 18, 30, 22, 17, 13, 08, 39, 35. It's a continuous number, 35, 24, 12, 34. It's just a continuous thing in that order. Good. So for our case here, they have actually simplified the work. They have given us the random numbers for demand and random numbers for lead time. So let's come to demand. The first random number, are you able to see the first random number? If yes, what is that number? 68. So let's have our 68 here. Good. If you look at the question, in all the past paper questions, I think they have been giving the opening stock. So if you read our question, it is not an exemption. It should be having opening stock somewhere. If yes, how many units? If yes, how many units? Okay, the last part here, we are going to do it together, don't worry. I'm going to adjust the board so that you see the last column. I'll be adjusting my board so that we are able to see the last column. 30. So we are told opening stock is equal to 30 units. Good. How many units are demanded during the year or during the day? We are doing it in days. How many units are demanded during the day? So this random number will help us get demand during that particular day. So our first random number is 68. We now go to that table. We now go to this table under demand. Where do 68 fall within the range? Where do 68 fall within the range? It is above 55. It is between 55 and 68. It is within this particular range. So within this particular range, can we go to the last column and check demand within that particular range? What are we able to see here? Demand will be 8 within this particular range. So the random number will take you to the range. Then from the range, we get actual demand. So how many units are demanded? 8. Thank you. We have 8 units. So if your opening stock is 30, you've been able to sell 8 units. What is your closing stock? What is your closing stock? 22. Thank you. 22 is your closing stock. The holding cost is incurred on the units available in store as at the end of the day. The holding cost is incurred on the closing stock. So if you look at our additional information, are we being given holding cost per unit? Are we being given holding cost per unit? If yes, how much is it? Additional information number 2. The holding cost per unit per day is estimated at 2 shillings. Right? So if you add 22 units in your store, what will be there? Is it 22 or 21? Okay, let's see. Which one are you referring to? Additional information number 2, the holding cost per unit per day is estimated at 2 shillings, while the unit shortage cost is 20 per unit per day. It is 2 shillings, right? 30 minus 8 should be 24. No, 22. 30 minus 8 should be 22, right? Good. Now, our holding cost is 2 shillings per unit, and we have 22 units, so it will be 44 shillings. Good. The next thing you need to ask yourself is, do we need an order? Do we need an order? You will only be able to answer this question by identifying the reorder quantity. I mean the reorder level. The reorder level. So can you go to the additional information and tell me if there's anything with regards to the reorder level? On a level, when your units get to that point, you must make a new order. So do we have reorder level in the question? If yes, how many units? How many units? Information number 3. Okay. The reorder quantity. When I'm going to make an order, I must order 40 units. That is the reorder quantity. If I don't have the order quantity in a question, I must look for economic order quantity. So economic order quantity or reorder quantity in this question is 40 units. And the reorder level or reorder point is 20 units. Our closing stock is 22. And the reorder point is 20 units. Do we need to make an order? Do we need to make an order? The answer is no. If you don't make an order, will you incur any ordering cost? Will you incur any ordering cost? So these are 0. You don't have any ordering cost here. You don't have any ordering. You don't have any ordering cost. Good. Now, shortage cost. I want us to listen and listen carefully. Shortage cost. This shortage cost will only be incurred when your closing stock is negative. When your closing stock is less than 0. If you look at our closing stock, is it less than or greater than 0? Is it less than or greater than 0? Our closing stock, it is greater than 0. So if it is greater than 0, we cannot talk about anything that relates to shortage cost. We don't have any shortage cost. Good. Which part should I repeat? Which part? We have said, first of all, get opening stock, which will be given to you on day 1. This opening stock, how do I deal with it? This opening stock, I need to get what is demanded during the year. What is demanded during the year will only be arrived at by using the random number. So the random number for demand, the first one is 68. I'll come to the demand range table here and locate where 68 is within the last column. I can see it is between 56 and 68. This is the range. What will be the demand in the last column or the first column? 8. That's what we have as demand during day 1. Now, if you have opening stock of 30 and the demand is 8, what do I need to do? My closing stock will be 22. Once I get closing stock of 22, I'm going to incur holding cost. So holding cost is equal to closing stock multiplied by holding cost per unit. In this question, holding cost per unit was 2 shillings. So 2 shillings by closing stock, which is 22, is giving us 44. Within the same question, we were told the reorder level. Once my units get to 20 units, I need to make a new order. So reorder level is 20. My closing stock is 22. It is above the reorder level, which means, do I need to make an order? The answer is no, because my closing stock is above the reorder level. Then, if I'm not going to make any order, I'm not going to incur any ordering costs. Let's come to shortage cost. My closing stock is greater than 0. It should be greater than or equal to 0, right? It should be greater than or equal to 0. So my closing stock is greater than 0. It is not equal to 0, but greater than 0. If it is greater than 0, then it means I'm not having any shortage. The shortage cost will only be incurred when my closing stock is a negative. For example, if demand here was 31 and my opening stock is 30, what do I have as closing stock? I have a negative. I have a deficit of 1. That deficit of 1 will attract shortage cost. Will attract shortage cost. Yes, will attract shortage cost. So as per this, our demand is 8. Our demand is 8. So 30 minus 8 is 22. This 22 greater than 0, I don't have any shortage cost. So how do I get total cost? The last column. Your total cost will be holding cost plus ordering cost plus shortage cost. Right? So if you add all those 3 costs, what are you getting as the total cost in the last column? What is your total cost? 44. Thank you. Let's go to day 2. Can someone give us the opening stock for day 2? Can someone give us the opening stock for day 2? Your closing stock for yesterday is the opening stock for today. Our closing stock for day 1 will be the opening stock for day 2. Let's come to random number. What is our next random number? Our next random number, we are still dealing with the demand. So our next random number after 68 is 13. So let's come here and pick that 13. If you look at the range, the demand table here, where will 13 fall? Between 10 and 20. So what is the demand at that particular point? What's the demand? 13 ranging here, so demand will be 5. Demand will be 5. Good. Your opening stock is 22. What is demanded during the year is 5. What's our closing stock? What's our closing stock? 17. So do we have holding cost? Yes. Do we have holding cost? Yes. This holding cost will be there so long as we have units that are greater than 0. So we have 17 units, which will attract holding cost of 2 shillings per unit. So what is our total holding cost? 34. Good. Now, the next thing, we want to compare our closing stock and the reorder level. For 13, pardon. What is our next random number? What is our next random number? This 22, you can obviously get it directly. Our next random number, please let me know. Our next random number. Linda, what's our next random number after 68? We are still dealing with the demand. So what's our next random number, Linda? After 68. 13. Good. It will help us to get demand for day 2. So we come here and look for the range. Where will 13 fall? It's above 9, but it's appearing between 10 and 20. It takes us to the last column, giving us 5 as demand. Our opening stock is 22. What is demanded during the day is 5. So we're going to have a closing stock of 17, right? Our closing stock being greater than 0, it will attract holding cost of how much? 2 shillings per unit. We have 17 units. So 2 shillings by 17 will give us 34. The next thing we need to do, we have to compare the order level and closing stock. Our order level is 20 units. The moment your units get to 20, you must make a new order. So do we need to make a new order? Do we need to make a new order? Yes, because what we are having here is not greater than the order level. So we need to make a new order, right? We indicate yes. The moment you indicate yes, you are going to make a new order, then you must incur the ordering cost. What did I say? The ordering cost is dependent on the number of orders. So what is the ordering cost per order? That information must have been given somewhere there. Is it information number 1, number 2, number 3? And if yes, how much is the ordering cost per order? Note number 1, the ordering cost per order is 80 shillings. So you cannot take 80, you multiply by 17. You cannot take 80, you multiply by 40. No, we take 80 the way it is and put it here because we're only making one order. Good. Before when we do anything, we need to consider the shortage cost. Or we can deal first of all with the ordering cost, all these things here, right? So once you indicate yes, we're going to make a new order. The next thing that will be considered is how long will it take for you to receive these goods? That's very important. How long will it take? Lead time. And we also have probability for the lead time. But before we go to the probability, now that we are using the random numbers for lead time, for the first time, what is our first random number for the lead time? What is our first random number for the lead time? 30. So once we have 30, our first random number is 30. How many days do we need to wait before this goods are delivered? This 30, this random number of 30 will help us to get the number of days. So come to this lead time table. Look at where 30 will be falling in which range? 00 to 19? No, that is above that. 20 to 49, I think it can fall within this range. So how many days? How many days? We need to wait for 3 days for us to be able to receive these goods. We need to wait for 3 days for us to be able to receive these goods. Good. Having done that, my next question is, when will we receive these goods? But even before we go to when will we receive these goods, when you're going to make a new order, when you're making a new order, how many units will you order for? How many units will be ordered? Economic order quantity, reorder quantity, it is somewhere there. Let's see. Information number 3. The reorder quantity is 40 units. So we are waiting for 40 units to arrive. On which day? After 3 days. What did I say about the reorder period? You start counting from the day that the order was made. We've been able to make this order on day 2. So day 2 is 1. Day 3 is 2. Day 4 is 3. We have to wait for 3 days to receive the goods. So when are we receiving the goods? On day 5. The goods will be received on which day? On day 5. The goods will be received on day 5. Good. Let's proceed. Let's proceed. So once that is done, do we have shortage cost? No. With a positive closing stock, shortage cost will not appear anywhere. So what is our total cost for day 2? We have incurred holding cost, we've incurred ordering cost. So when you add the 2, what are we getting? 80 plus 34, 114. So I believe you are making good use of the last column. Good. Let's go to day 3. Our opening stock. Our opening stock is 17. Our next random number after 13 should be 09, right? So let's come here and locate 09. 09, 09, 02 to 09. So 09 here, we have only 4 units that are demanded, right? So when 4 units are demanded, what will be our closing stock? Our closing stock is 13. This closing stock of 13 is greater than 0. It will attract holding cost. So what will be our holding cost? Our holding cost, 26. Our holding cost will be 26. Our holding cost will be 26. Great. Now, do we need to make a new order? Do we need to make a new order? Do we need to make a new order? Great. Do we need to make a new order? Do we need to make a new order? Thank you. Now, why are you making a new order? Yet, there's an order which you made here. How many units are we expecting? We are expecting 40 units. When you take 40 plus 13, what will we have? We'll be having 53. Is 53 less than the reorder level of 20 units? Is it less than the reorder level of 20 units? No, it is more than the 20 units. So we cannot make a new order yet. If our stock is put together at this particular point, we'll be having 53 units. So there is no new order that will be made. And therefore, we don't need to make a new order. Without a new order, there is no ordering cost. With a positive closing stock, there is no shortage cost. So what is our total cost? What's our total cost? It will only be this holding cost of 26 shillings. Repeat. Which one? Which part? Which part should I repeat? Which part? Need to order. Do we need to order? The answer is no. Remember, we've ordered how many units? 40 units. So these 40 units will be arriving after 3 days. So if you were to receive them at this particular point, we've made a new order, right? We made a new order of 40 units. So if I add 40 units to this 13, I'll be having 53. The only thing that's happening is we have deferred the receipt of these goods to which day? To day 5. So as at this point, we cannot make a new order unless what we've ordered for plus the closing stock is less than 20 units. If that is the case, then you need to make a new order. But if what we've ordered for plus our closing stock is greater than 20 units, which is the reorder level, then we cannot make a new order. Is it clear now? Is it clear now? Is it making sense? Great. So we are done with that day 3. Let's go to day 4. Let's go to day 4. The last day before we receive our new order. So we have closing stock of 13. It will be the opening stock here. Our next random number will determine our demand for the day. So what is the next random number after 09? How are we arriving to 40 units? Good. How are we getting 40 units? The 40 units we are referring to here is the reorder quantity, is the economic order quantity. If reorder quantity is missing in that question. So where are you getting 40, my friends? Where are we getting 40? Tell us where this 40 is coming from. Tell us. Where are you getting 40 from? Additional information number 3. The reorder quantity is 40 units. The reorder quantity is 40 units. Additional information number 3. Have you been able to see it? Have you been able to see it? Nabira, confirm. Great. So let's proceed. So the next random number after 09 ni ngapi? The next random number after 09 is 20, right? Good. So let's come to this demand range. Where will we get 20? 10 to 20. How many units? 5 units are demanded. 5 units are demanded. So 13 minus 5. What will be our closing stock? 13 minus 5. What will be our closing stock? 8. Good. 8 is a positive number greater than 0. So it means you're going to have holding cost. What will be our holding cost? What should be our total holding cost? It is unit multiplied by holding cost per unit. Good. So this one is the 3. Good. Do we need to make an order? We'll only say yes when what we are waiting for plus our closing stock is less than the reorder level. So 8 plus what we are waiting for, that is 40, will give us 48. Is 48 less than 20? The answer is no. So we cannot make a new order. Therefore, we get no here. Will we have ordering cost? No. Without making an order, there is no ordering cost. And with that, we don't need lead time. Shortage cost. Shortage cost, our closing stock is still greater than 0, right? So we don't have shortage. What will be our total cost? It is holding cost plus ordering cost plus shortage cost. Assuming the order was received. Assuming the order was received. We are actually receiving the order on day 5. So I want you to give me the opening stock for day 5. Remember, it is received after day 3. It is received after day 3. After day 4, we are receiving the goods. So I want you to give me that. So let's have this one here. Our total cost will be holding cost 16 plus 0 plus 0. That will be 16. The last column. Good. So let's come to day 5. Now that we have received the goods at the end of day 4, what will be our opening stock? What will be our opening stock? What will be our opening stock? We are receiving the 40 units and we closed with 8 units. So the total number is 48. 48 units. That's our opening stock. Good. With 48 units, the next random number, so that we can get demand on day 5. Our next random number after 20 is 73. So let's come to the demand range and look at 73. It will be between 69 and 78. How many units are demanded? 9. So when you have 48 and 9 units have been sold, what will be your closing stock? 39. What is the holding cost? 78. I can see people are now having the concept. Do we need to make an order? Compare this and 20? No. Without an order, there is no ordering cost. You're not going to compare anything with the random, right? Shortage. Is this one here less than 0? No. So we don't have shortage cost. What will be our total cost? It is holding cost plus ordering cost plus shortage cost. So we are going to have 78 as the total cost. Let's go to day 6. Our closing is 39. It becomes the opening on day 6. Then we go to the next random number for us to be able to get annual demand. Demand for that particular day. So 39 or after 73, we have 07. 07 for this table here, it will be between 02 and 09. What is the demand? 4 units. 39 minus 4 units will be having 35 as the closing stock. 35 as our closing stock. What will be our holding cost? 70, right? 35 by 2. Then, do we need to make an order? 35 greater than 20. Without an order, there is no ordering cost. With this one here being greater than 0, we don't have shortage cost, right? We don't have shortage cost. So what is our total cost? Holding, ordering, shortage. That will give us 70. Great. Let's come to day 7. On day 7, our closing is 35. We'll be having that as opening for day 5. For day 7, right? 35. Good. The next random number so that we can get demand for day 7. After 07, we have 92. That's the next random number. So we come to our demand table here and look at 92. Where will we find 92? Between 87 and 93. What is the demand? 11 units are demanded here. So 35 minus 11, what are we getting? 35 minus 11, 24 units, right? 24 units. 24 greater than 20. So there's no ordering. There's no need of making an order. And without that, there is no ordering cost. How about holding cost? You are closing multiplied by 2 or multiplied by holding cost per unit. It will give us 48. With a closing stock greater than 0, we don't have any shortage. And we need to get our total cost. So what will be our total cost? Our total cost is upon that 48. Holding, ordering, that's shortage cost. With a closing stock of 24, it will be our opening stock here. After utilizing this random number of 92, the next one will be 99. Where will we get 99? It is between 94 and 99 here. How many units will be demanded for day 8? 12 units. With that, what will be our closing stock? What will be our closing stock? 12 units. That will be our closing stock. So let's deal with the holding cost first. We have closing stock of 12 greater than 0. So we have holding cost of how much? 12 by 2 will give us 24 shillings. Look at our closing stock. Compare it with the reorder level, which is 20 units. Do we need to make an order? Do we need to make an order? Yes. The moment you indicate yes, what will be your ordering cost? What will be your ordering cost? 80. Good. The moment you indicate yes, you need to make an order. The first random number which was used under lead time was 30. So what is the next random number? What is the next random number? 22. So go to the lead time table and look for 22. Where will it fall? Locate 22 from this table. It is between 20 to 29. What will be the lead time? 3 days. 3 days. What did we say about the lead time? You start counting from the day when the order was made. So day 8, that is 1. Day 9, that is 2. Day 10, that is 3. When are we receiving the goods? When are we supposed to receive these goods? Day 11. Day 11. Is it part of the question? Is it part of the question? It's not part of the question. So you don't even need to get there. Good. Let's come here. With an order shortage, our closing stock is still greater than 0. So we don't need to make a, we don't have shortage cost. We get a dash. Good. Then let's move with speed. Let's move with speed. What's our total cost here? It is a holding cost plus ordering cost. 24 plus 80. Itakuwa ngapi? 104. Let's go to day 9 now that we've been able to see the pattern. Day 9, our closing stock is 12. Come here and we get that 12. The next random number after 99 is 93. 93, come to this table. We have 11 units that are demanded. Good. So when 11 units are demanded, what will be our closing stock? Our closing stock will be 1. Our closing stock will be 1. Do we need, so what is the holding cost? 2 by 1. Do we need to make an order? No, we still have 40 units that will be coming, right? So we don't need order, we don't have ordering cost. It's not random number. Shortage, it is greater than 0. We don't have shortage cost. We don't have shortage cost. What is the total cost? It is holding, ordering, shortage. Let's go to day 10. Let's go to day 10. What is our opening stock? 1. What is the next random number after 93? 18. 18. Let's locate 18 here within this range. 10 to 20. 18 will be 5 units. 18 will be 5 units. What is our closing stock? What is our closing stock? What is our closing stock on day 10? What is our closing stock? What is our closing stock? What is our closing stock? What's our closing stock? We have stock out of 4 units, right? Demand is 5, we only have 1. So what are we having here? We are having a deficit, right, of 4. But I don't encourage you to indicate negative 4. I don't encourage you to indicate negative 4. You know, when we have a deficit here, there, yes, we don't indicate. So do you need to make a new order? Do you need to make a new order? No. We are still waiting for those 40 units on day 11, right? So we are still waiting for them. Now, holding cost, we are holding nothing, right? We are holding nothing. Kindly repeat on number 8. Which one? Day 8 or number 8? Which one are you referring to? Day 8. From which point? So day 8, we had opening stock of 24. This random number gave us demand of 12. So what you have as opening minus what was demanded, we are getting 12, right? So this 12 times 2, which is holding cost per unit, is giving us 24. Compare this 12 with the minimum stock level or the reorder point, which is 20. This one is less than 20, so we need to make an order. When you make an order, you go to the next random number, which is 22 for the lead time. 22 is within this range, giving us 3 days as the lead time. So we have this lead time of 3. We have to wait for 3 days. 1, 2, 3. The 4th day we are receiving the goods will be day 11. But it's not part of the question. So even you need not to be worried about it. Having done that, we come to day 9. Day 9, we have opening stock of 12. This random number is giving us demand of 11. Our closing stock is 1. With closing stock of 1, we are still waiting for the 40 units. They have not arrived, so we cannot make a new order, right? But now, our holding cost is 1 times 2, giving us this. Do we have shortage? The shortage cost will only come in when your closing stock is a negative. The shortage cost will only come in when your closing stock is a negative. Good. So let's come to day 10. Our opening stock is 1. The next random number after 93 is 18. When I come to this table, 18 is between 10 and 20, giving us a demand of 5, right? Shortage cost in day 8. How? What will we each shortage cost? Ukiona your closing stock will be a negative, then shortage cost will come in. So do we have closing stock of a negative here on day 8? Do we have negative closing stock on day 8? We don't have, right? So we cannot talk about shortage cost when our closing stock is greater than 0, or if not a negative. When you come now to day 10, your opening stock is 1. With this random number of 18, demand is 5. We have opening stock of 1, demand is 5. So 1 minus 5, what are we getting? Negative 4, right? Negative 4. So negative 4, we cannot write negative 4. We just write 0, 0. And 0, 0, we have a shortage. As at this time, even though we are waiting for 40 goods, which will be received on day 11, on day 10, we have a shortage of 4 units. We have stock out of 4. units. So that stock out of 4 units, we cannot sell to them, right? They will go to our competitor. They will go to our neighbor to purchase the same product, to purchase the 4 units. So that's why now we bring in the opportunity cost, which we call shortage cost. So as per our question, were we given shortage cost per unit? And if yes, how much is it? Were we given shortage cost per unit? And if yes, how much was it? Shortage cost per unit. Shortage cost per unit. Were we given shortage cost per unit? If yes, how much was it? 20 shillings. 20 shillings per unit. 20 shillings per unit. So how much will we have here as the shortage cost? We have a deficit of 4 times 20 is giving us 80. Is giving us 80. Good. How about holding cost? We have a negative, so we are holding nothing, right? How about ordering cost? We are not going to make any order because we are waiting for how many units? For 40 units. So without ordering or without making an order, there is no ordering cost. So what is our total cost? What's our total cost? What's our total cost? 80. Thank you. So can we add everything? Can we add everything in the total cost column? Are we able to add everything in the total cost column? Total cost column, total cost column. Total cost column. That is 44 plus 114. We have 1 minute to go. We have 1 minute to go. So add everything there, add everything there. Add everything there. Total cost tutakuwa na ngapi? Step here. Good. So total cost tunapata ngapi? 582. 582. So we have 582. It is the summation of shortage cost plus ordering cost plus holding cost. Very simple. Just take 582 minus 80 minus 60. Or 582 minus 1 or minus 240. 582 minus 240 tunapata ngapi? 582 minus 240. What are we getting? 342. 342. So what are we required to do? Using the simulation of the above problem for 10 days, determine the average daily cost using the following random numbers. So we have 10 days and we have total cost of 582. What is the average? 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 Average will be 582 divided by the number of days. Are you getting anything close to 58.2? 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 That's what you are required to do in that particular question. That's what you are required to do in that particular question. Good. So I believe with that, we should be able to stop. Why is ordering cost shillings? Soma your information. What are they telling us? Is it ordering cost per unit? Is it ordering cost per unit? Remember, the question is very clear. Every time you're going to make an order, you are ordering 40 units. So we made an order at this point. We made one order. We were waiting for 40 units that was received on day 5. We just made one order. So for this particular order, you incur 80 shillings per order. That's why we have it. On this second order, we made an order, just one. So that one order, we are waiting for 40 units, but we incurred 80 shillings per order. When I was introducing this concept, I said, ordering cost is dependent on the number of orders. Holding cost is dependent on the number of units. Shortage cost is dependent on the number of units. About the lead time, random number. Why not considering the days of the random number, not per unit? Which days? Which days? So random number, this 30 is giving us, within this range, giving us how many days? 3 days. Those 3 days are what we are counting here. Day 1, day 2, day 3. So we are receiving them on day 5. Day 1, day 2, day 3. We are receiving them on day 4, which is 11th day here. Is it clear? Is it clear? Is it clear? Becky and Eunice confirm whether your question is taken care of. Becky and Eunice confirm whether your question is taken care of. Becky confirm. No. So which part? About the lead time. Why not considering the days of the random? I don't understand the days of the random number you are referring to. If it is 3 days, lead time is, we need to wait for 3 days before we receive the goods. And I explained clearly at the introduction part. The 3 days includes the day that the order was made. After the 3 days, we receive the goods. It means we are receiving these goods at the end of day 4. They will not form part of the closing stock on day 4, but they form part of the opening stock on which day? On day 5. That's why we indicate they are being received on day 5. After the 3 days are gone. After the 3 days are gone, we should receive them on day 11 here. Days and 10 days. The next number is on the 8. Okay. The next random number was the 8. No. Don't consider that. Don't take it that direction. Also, according to you, this random number we are talking about here is happening on the 8. So you want us to consider 8 days. Why not use 24 as random number? Why not use 24 as random number? Oh, I've now seen where it is. I also said this as I was introducing the question. I said very well that, you know what, in some questions, you'll be given combined random numbers. They are not going to separate for demand and lead time. So what do I need to do? If they are combined, I'm going to use 68, right? Then the next random number has been used for lead time. So I cannot go and use this 30 again for demand if they were combined. No, I cannot use them like that. Now that that has been used, I go to the next one. Yes, so that is it. So let's stop at that particular point.